If you would have told me when I was 40 that just over 10 years later I'd be preparing to retire from the corporate world, I would have thought you were delusional. Not because I didn't believe I could build wealth. I'd already accumulated a few million in the bank, but because I was completely clueless about how to turn that big number on the screen into dependable income my family could actually live on. I could build companies. I could manage teams. I could architect complex tech systems, but somehow nobody had taught me how to architect my own retirement. Today, I'm going to show you the exact framework that took me from stuck with millions to retired and financially free at 51. So let's start with the problem most high earners face. You've got $3 million in your portfolio, but your financial advisor says you need $5 million to retire safely. And actually probably $7 million with inflation. Or maybe $10 million if you want to travel and have a summer home. So the goalpost keeps moving. You save more, your portfolio grows, but retirement stays just out of reach. I've lived this. I had a few million in the bank, but was stuck working 60 hours a week in a very stressful tech executive role because I didn't think that there was any option besides the standard drawdown portfolio, which has you saving and waiting until I was 67 to retire. The pivot came for me when I realized my 3 sons were growing up and I was only getting glimpses of it. That's when I started studying how ultra wealthy families actually structure their portfolios. And what I discovered confirmed my suspicions. They weren't all tossing their wealth into stocks and hoping that the market goes up. They had architected portfolios that accomplished 2 goals at once. They were growing the principal and they were living off the income from their investments while never selling the principal. So I started shifting my thinking. What if my portfolio generated enough income to replace my paycheck at 51 instead of 67? What if my wealth actually grew while I was living off of the income? I call this the Evergreen Portfolio model. Right now, I'm 56, and my job for the past 4.5 years has been running my microfamily office. I was able to walk away from a high-paying career at 51, not because I'd saved my way to $20 million, but because I restructured my $6 million portfolio to generate income while continuing to grow. Here's the fundamental difference. The traditional model has 2 components: growth assets like stocks and capital preservation assets like bonds. The Evergreen portfolio has 3: growth, capital preservation, and the critical missing piece, income-focused investments. The percentage of this 3rd component that you have in your portfolio can vary greatly depending on several factors like age, portfolio size, income needs, and risk tolerance. For example, someone 5 years out from their target retirement date, you might have 25% of your portfolio allocated to income investments and the majority still compounding in growth investments. Someone retiring tomorrow and exiting their active income source, they might be 50% or more in income-focused investments. The goal here is simple: grow your principal while funding your lifestyle. So let me break down each of the 3 components in just a little bit more detail. Component 1 is growth assets. These are your traditional stocks and index funds, but could also include more risky investments like venture capital. A growth investment is anything that has the goal of long-term appreciation. Now, component 2 is capital preservation asset. Things like bonds, treasuries, gold, and other cash equivalents that act as a ballast during volatility and a safety net in case of a black swan event. But here's where it gets interesting. Component 3 is your income-focused investments. There are options that your advisor might mention to you, such as municipal bonds, dividend stocks, or public REITs. And there are options in the private markets that they likely won't bring up to you, such as private credit, triple net leases, or private equity real estate funds. Let me give you a concrete example of income investments. After I moved to Austin, I bought my primary residence plus 5 single-family rental properties. The income from those 5 properties covered a substantial portion of my family's essential living expenses. This was my aha moment. Assets generating actual cash flow I could live on. But here's what really blew my mind: the tax treatment. When I sat down with my CPA to look at the numbers, I realized something most people miss. If I needed $175,000 for living expenses and got it from my stock portfolio, I'd actually have to sell $225,000 worth of stock because I'd lose $50,000 to capital gains. But with my rental properties and the private equity, real estate, and private credit investments that I've added since, I'd take $175,000 in distributions, and most of it comes to me tax advantaged or even tax free through depreciation and other strategies. Same lifestyle, completely different tax treatment. And critically, my principal keeps growing while I'm living off of the income. That's when I knew that this wasn't just a better approach, it was the only approach that made sense. So let me show you what this looks like with real portfolio numbers. I'm going to start with a very simple example, a $3 million portfolio with a 50-50 growth in income split. You allocate $1.5 million to income-focused investments at an 8% blended yield. That's $120,000 in annual cash flow. Then you add $1.5 million in growth assets, generating roughly 1% dividends. That's another $15,000. That is $135,000 of annual portfolio income without touching the principal. Now, of course, this is simplified. You'd also want to add capital preservation assets, but it shows you that you might be closer to retirement than you think. Let's look at another example and answer the question. How would you structure a $6 million evergreen portfolio for someone that is knocking on the door of retirement? They're risk adverse and they want to maintain a comfortable lifestyle with $250,000 in annual burn. Here's one way to structure it. Start with your growth bucket, 30% or $1.8 million. This continues compounding at market rates and kicks off about 1% in dividends, roughly $18,000 annually. Next, your income bucket. This is the workhorse of your portfolio. That's 50% or $3 million, generating an 8% blended yield, which produces $240,000 in annual cash flow. Add those together and you're at $258,000 per year, comfortably covering your $250,000 lifestyle. And here's the safety net. You still have $1.2 million sitting in your capital preservation bucket. 20% in low risk investments, keeping pace with inflation there when you need stability. Now, your specific allocation will look different based on your goals. Are you legacy focused? You're going to reinvest more of that cash flow to maximize compounding on the next generation. Bullish on the markets? Tilt heavier towards growth. Are you more conservative? Increase your capital preservation bucket. The right portfolio structure is the one that hits your goals, not some generic formula. And if you want help establishing these goals and defining your investment thesis, head to our upcoming free live workshop. I'm going to share the link at the end. Now, here's why this matters so much. If you retire using a traditional drawdown portfolio, your success depends heavily on when you retire, not just how much you saved. This is called the sequence of return risk. Look at these two scenarios. Scenario number one, you retire in 2008 after the great financial crisis with a $3 million portfolio, 60% stocks, 40% bonds. Over the next 16 years, it almost triples in value while paying you $120,000 to $300,000 annually. Scenario two, you retire in 2000, heading into the dot-com crash with the exact same portfolio. After 16 years, it's worth less than when you started and only paid you $80,000 to $120,000 per year. Same strategy, same discipline, different timing. One person retires comfortably for life. The other might have to go back to work. This is why I think about portfolios completely differently now. A drawdown portfolio is like filling a grain silo throughout your career, then slowly emptying it in retirement, hoping that you don't run out before you die. An evergreen portfolio is like planting an orchard. Your assets produce annual harvests without chopping down the trees. The evergreen approach removes the timing risk entirely because you're living off cash flow, not selling assets. So how do you actually make this transition? I break it down into 3 sequential phases: architect, build, and run. In the architect phase, you get crystal clear on your why. Define your legacy statement. Develop your investment thesis. Assess your risk tolerance and timeline. Most people skip this and wonder why they can't make progress. The second phase is build. This is where you create the infrastructure, your portfolio business structure, your team org chart, your systems and technology. You start making the actual moves, divesting from concentrated positions, deploying into income-focused assets, optimizing your tax structure. And the third phase is run. Here you're transitioning into your operating rhythm, monthly, quarterly, and annual reviews. You're managing your wealth like a business now, monitoring performance and making strategic adjustments. But as you move through these 3 phases, there are 3 costly mistakes that you have to avoid. 1, moving too fast and triggering massive tax bills. Divesting requires strategy. You need to have a well thought out game plan and engage somebody like a certified tax planner to ensure that you execute this the most efficient way possible. Number 2, over-indexing on income investments too early. You still want compounding working for you on your growth investments, especially in your 30s, 40s, and early 50s. 3, poor investment sizing. You don't put $1 million into a single investment from a $3 million portfolio. The rule of thumb I tell people is that no single investment should be more than 10% of your portfolio. And for me personally, it's more like 5%. If you begin this process with these 3 things in mind, it will make the transition from the drawdown to the evergreen portfolio much more efficient and painless. Here's the reality. This approach isn't complicated, but it's different from what traditional financial advisors teach. Most advisors won't show you this because their business model depends on keeping your assets in public markets and keeping things as copy-paste as possible for them so that they can manage as many clients as possible. I built Wealth Ops because I was frustrated by the lack of real guidance for high earners with $1 million to $30 million who wanted to take control and manage their wealth like a business. So if you're tired of the wait until 67 advice, I would love to have you at our upcoming workshop where I'll show you exactly how to architect, build, and run your own wealth as a business. I call this a microfamily office, and it's the same framework that took me from stuck with millions to retired and financially free at 51. We run these every few weeks so that the next one should be right around the corner no matter when you're watching this. Just head to wealthops.io/go or click the link in the description section right below this video. After you do that, if you want to learn more about the microfamily office concept, check out this video. Thanks for watching. I'll see you in the next one.